What's the outlook for the U.S. economy and the financial markets for the next 2 years? Today, we're joined by Sam Burns, Chief Market Strategist at Mill Street Research. Sam has a lot of experience in not just analyzing markets, but in guiding investors in prudent investing strategies. So without further delay, we're going to talk about these topics. And let me just start out by saying, Sam, welcome to the program.
No, my pleasure. Thank you for having me on, Patrick.
Yeah, I wanted to start, Sam, kind of with a broad question, and that is, what is your perspective on the market overall right now? Like looking out, say, the next 2 years, what is your belief about the U.S. economy and the financial markets?
Yeah, I think for a little while, I think the markets are still look pretty good. Certainly, the equity markets more so than the bond market. I've been favoring equities over fixed income in terms of investment allocation for a while now, and still do. I think sometime next year that may change. I think that the economy has done a lot better than most people expected it to, and that applies to corporate earnings as well. And that's helped stocks more than bonds and fixed income. But I think that may shift, as we go into next year, and a lot will depend on policymakers, both monetary policy and fiscal policy. So that's kind of what I'm going to be looking at, going forward, to see if the supportive balance we've had over the last year or so will continue, or if there will be a shift that will make things more contractionary and slow growth, and potentially, present hurdles for equity markets.
So is your belief then, based on your analysis, that you think maybe next year there's going to be a lessening of that support to equities through fiscal policy?
I think so. I think the big thing that's been happening over the last year or two has been that fiscal policy has been supportive and quite strong, and that's helped offset tighter monetary policy, higher interest rates. And I think a lot of people had been focused so much on interest rates and the Fed that they kind of overlooked the fiscal side of things. And whereas I was seeing it very clearly in a lot of the underlying earnings data and things that I track, whereas I think that's going to kind of slow down and maybe peter out as we get into next year, because I don't think we're going to get any new fiscal support given the way Congress and sort of the government is right now, like we've had the last year or two. So I think to the extent that we get less fiscal support and potentially continued tight monetary policy, that could then have an impact on slowing things down next year sometime, depending on what happens globally and what happens here in the U.S. with politics and things.
So based on that, you would see right now as a good time? Again, we're not giving financial advice, individually
Right.
to people, but you think now would be a time where you would start maybe migrating some of your portfolio more into fixed income in preparation for that?
I
Or
would
not?
certainly think about it. Like I say, I think we might have some further gains in equities for at least maybe through the end of the year, early next year. And once people start talking about maybe rate cuts from the Fed, which may be a little while, but then that will usually produce a boost of some kind. But my concern would be that as rates continue to rise in the bond market, and the support from fiscal policy looks like it may fade over the next year or two, then maybe 6 months from now we want to think about more about reallocating back towards more fixed income and less equities. But for the time being, I'm comfortable with equities, but I'd probably reevaluate that first quarter next year.
That's a great perspective you have, because I don't think a lot of people really understand that or realize that as much. And I have a question about that, particularly the bond market. Do you foresee? I guess what you're saying is you foresee the bond market as potentially being, a value investment right now, or at least in the next several months. I don't know if that's a proper assessment of where you are on that or not. But tell us a little bit more about your feelings about the bond market, both the short end and the long end.
Right. Yeah, no, I think definitely the long end of the bond market is getting more attractive than it's been for a number of years. There was a long time there where it was really unattractive, both because of the low level of yields of interest available, but also because of the inverted yield curve. And that you could get more on your, on cash, a money market fund, than you could owning long duration assets, where you're taking a lot more price risk, where there's a lot more volatility. And we've certainly seen that this year. Bonds have really been in a bear market for mean, arguably 2 or 3 years now, and certainly the last few months have been particularly, bad for bond investors. So I think there's a chance that that goes on a little while longer. It takes a while for that kind of, a sort of a move to wind down and to shift. So I don't think there's any kind of, you need to race out tomorrow and buy bonds. But I think that as bonds get closer, the bond yield on, say, the 10-year bond, for instance, gets closer to where Federal Reserve policy rates or the short-term interest rates are, then the risk in owning them goes down. So as the yield curve becomes less inverted and the level of rates goes up, I think that the value of bonds will continue to increase in terms of their investment benefits. And I think that the worry about inflation that a lot of people have had for a long time is really very much a fading worry. I don't think that's going to be a problem. I think rates are already noticeably higher than inflation, and I think that there's not, barring any really big global shocks, I don't think there's much risk that inflation comes roaring back. It's not like the 60s and 70s now, or early 80s. So I think this is a little bit more like the post-World War II period, where you had a big burst of inflation and then it settled down once things kind of stabilized. And so that's why I think inflation is not going to be a big problem. So at some point here, in the next few months, maybe bonds will be a better value.
When you say you feel like the inflation is more like post-World War II, are there particular indicators to you that suggest that it's more that and less 1970s style inflation?
Yeah, there's a few things. One is that the trends in commodity prices over the last couple of years very much kind of look like that pattern. You had a big run up in 2020, 21, and early 2022 from both COVID, stimulus and things, and then the invasion of Ukraine by Russia, which cut off oil and gas supplies and things like wheat. So you had a big supply shock caused by the pandemic and war in Europe. But now that we've kind of moved past that, and a lot of the oil and the other things are still kind of flowing, it's kind of discombobulated, but it's still there. And the markets have kind of figured out ways to adapt to that. So a lot of the prices for oil, natural gas, wheat, all those things are back down to below where they were before Russia invaded or before even COVID started in some cases. The other thing you've got is that a big driver of demand globally for the last 20 or 30 years has been China. And I think they're not going to be a source of global growth and demand to nearly the same degree. So as a source of inflation, I don't think they're going to be a big driver. And then you also don't have the demographics. The baby boomers were all entering the workforce and having babies in the 60s and 70s. I was one of those in Gen X. That was a big demographic kind of bulge and boom there that made a lot of demand for consumer items globally and everything that happened then. And you had Vietnam War, and you had the big oil shocks in 1973 and 79, and you had a lot of other things going on at the same time. The lagged effects of Social Security and Medicare coming in the late 60s in terms of fiscal policy. So all those things had to combine to produce the inflation we saw in the 70s. And so we don't have anywhere near that kind of mix of things now. So whereas post-war, you had, all the resources had to get devoted to the war. And then once people started coming back from the war and all the wartime, activity started shifting back to civilian use, basically the supply chains, in the same way that COVID broke a lot of supply chains in World War II got broken. Now they came back, and then inflation spiked for a while once everybody started buying things again. But then after a couple of years came back down again. Interest rates had to adjust higher to some degree. But then again, they stabilized, and the stock market and corporate earnings and the economic growth really stayed pretty solid for a while after that in the 50s. So I think it's closer to that. We don't have the same demographics and things, but we have the same kind of big shock from COVID and Russia that's now fading, and we're kind of going back to kind of pre-COVID conditions of slower growth, weaker demographics, and less of that inflation pressure that we would have had otherwise.
What do you say to those who view kind of the fiscal policy right now? You had said you see potentially that stimulus petering out, going into next year. What do you say to those who will say, most likely our leaders aren't going to let that happen? Meaning to say they want to protect their political careers, and so they're going to want to keep that the market kind of buttressed, if you will, with additional spending, and that might contribute to continued inflation.
No, and it certainly is a thing to consider. I guess in some ways, I would say that there's a lot of the cycles in the past, the last 20 or 30 years, where they have not done that, meaning that the Congress could have stimulated and spent more money, and they in fact chose to focus on deficit reduction and that kind of a theme more as a political tool rather than aggressive spending plans. And so I think that given the current makeup of Congress right now, I don't see the risk of any big new, certainly nothing like the Infrastructure and Jobs Act or the CHIPS Act or the Inflation Reduction Act. Those are really the big things that are currently now supporting both the economy sort of in terms of jobs and things, but also increasing productive capacity. There's a lot of factories being built right now to build electric vehicles and batteries and all kinds of things that are a result of that earlier, those programs that were passed. And I think that's helping in the sense of increasing supply in the economy and therefore potentially reducing inflation over the longer term. Whereas, for instance, tax cuts and things, which have been, a way to do that in the past, don't have the same stimulative effect on the overall economy or on the supply of, productive capacity. So in some ways, this has been a very unusual situation historically, certainly compared to the last 30 or 40 years, where you've had stimulus that's come in the form of that kind of direct investment related, manufacturing related, drivers. And so I think that, that was a good thing that it happened. I don't think that's going to happen further because you don't have the sort of the support from both sides of the aisle to do that right now. Now, maybe I could be wrong, and there could be other ways that they do things. But given the way what I'm seeing in the politics now and the historical tendencies, I don't really see that as likely. I think it's actually more likely that you'd see some people pushing to cut the deficit and cut spending more than increase it over the next couple of years. So I think that's more the risk of kind of the policy mistake of tightening too much than being too loose.
You know what? I wanted to ask you another question about bonds before we move on, because I really wanted to get your take on this. There's a lot of debate about the CPI and whether or not it accurately captures, the real inflation rate or the real increase in prices that most people pay for most things. First, it's kind of a two-part question. First, what are your thoughts on the CPI? Is it accurate? And then secondly, if not, is, the Fed, they continually talk about keeping rates real, positive in a real sense, right? They want a real positive rate in order to be, quote unquote, restrictive. Mm-hmm. If the CPI is not accurately measuring inflation, could they be, actually not restrictive right now? Could they actually be cutting rates too soon if we were to go into next year and they pivot? And then, and the reason I'm asking this, I don't want to make this question too complicated. The reason I'm asking this is, could inflation expectations, if they were to cut, kind of ignite yields on the long end and actually result in more of a bear market in long bonds? But go ahead. I didn't mean to throw too many questions in there, but I'd like kind of get your feel on that.
Well, right. Yeah, no, I guess if you thought that inflation would pick back up again, then that would be, certainly negative for bonds, certainly for the longer term bonds. My view has been that inflation is likely to continue to slow, if anything, or at least be stable. And in terms of the CPI and how it's calculated, inflation conceptually is a very difficult thing to measure anywhere by anyone in any country in any time frame. And there's a lot of, when you start really looking at how you measure prices for anything that's not strictly a commodity, I mean, it's the same thing every month, every year, and you can track the price, accurately. There's a lot of things that we buy and sell every day, and some things that we actually don't buy and sell that are still in the inflation indices that are hard to measure. You can mention healthcare. What does healthcare cost? Nobody knows. Right. What does education really cost? A lot of that is hidden. There's a lot of things that are very hard to measure by anyone, anytime, anywhere. And so it's always a struggle. Now, I think that the CPI, and certainly the Bureau of Labor Statistics and the people who produce the data are doing the very best that they can. I think that they're doing it as accurately and sort of as they can. I don't think there's any attempt to skew the data intentionally by anyone that works in those departments. I think that things like rents, for instance, the housing component of the CPI or the personal consumption index that the Fed watches, is tricky lately because the way they measure, for instance, the cost of housing and shelter is based on what they see in rental prices, because of course, a house is both an asset and a provider of housing services. And so they have to sort of figure out, well, what would it cost you to rent your own house from yourself, as kind of their proxy for what it's, really costing you. Well, of course, you don't really know that, but so they use rents to proxy for that, but they also use rents that are what people pay on a lease, which means you sign a lease for 12 months. You don't reprice your monthly lease on a rental property every month, but other prices do change every month or every day. Gasoline prices or the price of eggs can change around, but the price of a lease that you sign for a year won't change until you sign a new lease. So there's a lag embedded in the price of shelter housing in the CPI. It's always been like that. That's been a construction for decades. So it's not that it's wrong, and that is in fact what people kind of perceive, in the sense that if your lease is locked in for a year, even if rates, rental rates go up next month, you won't pay that until you sign a new lease, months later. So there's things like that as an example of how the data can be accurate in the sense that it's measuring what it's meant to measure, but not useful for forward-looking monetary policy purposes, for instance.
Right.
Because if you're looking at data that is lagged because of that construction, it's not telling you what inflation or rents, for instance, are doing right now. It's telling you what they have done on average over the last year-ish. And that's not going to be a good forward-looking measure. So there are other data you can look at that measure apartment prices or rents or housing prices, today, and do update every month. That's just not what goes into the CPI. And so when you're thinking about what the Fed is looking at, or what you and I can look at in terms of where is inflation actually going over the next year or so, you kind of have to adjust for things like that and compensate with the fact that housing prices, they're in the data, they look like they're rising slower and later, and then coming down slower and later than actual housing prices did, if you look at what more current numbers are. So it's things like that I think are the confusing part of inflation. It's not that the government is intentionally trying to skew the data up or down, because there are ways in which they could actually have incentives to do either. But I think they're trying to make as accurate data as they can, but it's hard. And I don't know what the alternative would be actually to measuring a lot of these things. If you say, well, the CPI is no good, what else are you going to use? That's the best data we have. It's as good or better, I think, than any of the other countries I've seen their data has. So I think it's useful data, but you have to know how it's built and get into the sausage making a little bit sometimes to understand why you might not want to use it for forward-looking purposes, in some cases.
Yeah, it makes sense. Speaking of which, a lot of our viewers are either active military veterans, or government employees. And you may know this, there's a retirement program they have called the Thrift Savings Plan. Mm-hmm. And there are a number of different index funds in there. And I know there are also target date funds that they have. And again, we're not giving out individual financial advice with this discussion. But I know that one of the funds, which is really focused, it's a bond index fund, is kind of focused on more longer term bonds. And so, based on what you're saying, not that we're giving financial advice, but it could be an opportunity for some people to maybe shift a little bit of their money into the F fund, is what it's called, okay, in order to kind of capture those prices of those longer term bonds where they are right now, which may actually be cheaper and a good investment opportunity.
I think that's right. I think that definitely you're in a much better position now to consider, maybe reallocating a little bit more of, particularly if you're currently, active and you're contributing money out of your paycheck to, the retirement fund, in the sense, and you're not too close to retirement, then I think, putting more in that direction, might make sense, and something that would be sort of a gradual thing you would do over time, as opposed to taking all your money shifting it dramatically one day from
Right.
stocks to bonds or something, or out of a money market fund. So I think it would be sort of an incremental step to do. But yeah, you're definitely getting a much better deal on bonds now than you were even 6 months ago or a year ago, and certainly more than 2 years ago. And so, of course, there's been more volatility in the long-term bonds than there has been, historically, for quite a while. So if you're looking at your statement every month and you see your bond fund bouncing around more than you expect, that's don't be surprised if that continues for a little while longer. But I think there's definitely a better chance that bonds, so over the next 5 to 10 years, will give better results than they have over certainly the last 5 or 10 years.
Do you see index funds, the concept of index fund investing, because that's kind of what a lot of retirement programs are based on. Do you see that as being a good strategy or not? Like, what are your thoughts on index funds?
No, I'm very much in favor of index funds. When I help my own family, several of whom are military veterans, manage their portfolios. And I pretty much almost entirely use index funds or ETFs that are basically based on indexes, because they really are in many cases the lowest cost option that you'll have. The fees that are attached to them and the amount of turnover that they incorporate and their tax benefits to using them. A lot of those things are big benefits, particularly if you're holding them over long periods of time. So I think there's very much a very strong case for index funds and ETFs that have very low expenses as a way to avoid paying a lot of fees to money managers and the people who run the funds. So there's only occasionally cases where there are sort of more niche areas where an actively managed fund might benefit you. So, like if you're investing in emerging market equities, for instance, that's an area where you might pay to find an active manager that does a good job over time. But for basic, large cap U.S. equities or bonds or anything like that, you should almost certainly stick with an index fund that matches your risk tolerance, or something like a target date fund where the balance is in line with your longer term goals and how much risk you're willing to take.
You mentioned emerging markets and maybe some other outlying areas. I know that some of our viewers sometimes have money that they want to put in something other than index funds to diversify a little bit. Not that index funds aren't diversified, but just they want to capture maybe another particular sector that they're bullish on. What sectors of the economy, let's say over the next 2 years, do you think look more favorable right now? Again, we're not giving financial advice, but just your perspective.
Right. Yeah, no, not giving anyone specific advice, but when I look at things, I think the longer term kind of view is still that, particularly here in the U.S., is that technology and anything kind of tied to technology is really where a lot of the growth has come from and probably will continue to come from, in the sense that, like I said, the demographics and a lot of the longer term drivers of things like manufacturing are more cyclical and are going to be up and down. But the kind of the longer term trend of technology being the driver of productivity and things like that is still there. And really it's really a question of kind of timing things in the sense of not paying too much for it. The valuations, and when sometimes technology kind of gets ahead of itself and then has to correct, and then that's a better time to buy. So I think from a long term standpoint, you definitely, or a lot of people want to have at least some exposure to technology and things that are tied to technology. Now, to be clear, if you buy, say, for instance, an S&P 500 index fund, which is just a very standard, index fund, it's got a fair amount of technology in it. So you already have a decent amount of exposure if you just buy a standard index fund. So now you might want even more than that, but depending on your risk tolerance. But I think that you should look a little bit at the funds you buy and see where the weights are. You own a fair amount of technology and things like that are maybe in consumer discretionary or communication services that are tech related. And so now that's not true, for instance, in other countries. If you invest in a fund that invests in Europe, for instance, you're not going to get much technology. You're going to get a lot of other industrial and consumer type sectors and things like that. So if you're investing globally at all, or in things that are not U.S. large caps, then it's worth a look to see what's in the fund, even if it's an index fund, that kind of where your bets are being placed. But I think technology is a good place to look. Some of the consumer areas, the U.S. consumer is, has always been kind of the driver of not only the U.S. economy but the world economy. And to the extent that that continues, I think that'll be a good place to be. I think over the next year or so, I think the industrials area, particularly anything related to that kind of manufacturing boom that we're seeing right now, the last 6 to 12 months have been really strong in a lot of the work that I see, and I think that'll continue for a while longer. Whereas things that are more tied to, say, commodity areas or even to some degree healthcare is going to probably struggle some. I think they don't have the same kind of tailwinds that the other sectors do.
Okay, it's interesting. So you feel, pivoting to the areas you don't think will do as well, commodities, healthcare. What is it like, for instance, when I think of commodities, I think if we're having an industrial resurgence, in my mind, I'm thinking, there'd be greater demand for commodities. But, what is it that you see in the commodities market? And you can break it down further too, if you want to be more detailed, that you feel doesn't have as much potential, say, over the next couple of years.
Yeah, so when I'm looking at kind of the commodity markets and the companies that are tied to them, I see, again, most of the commodity trends that I see in aggregate, except for oil lately, are mostly been downward for the last year or two. And actually, when you saw earlier this year, for instance, OPEC, did some supply cuts to try to boost the price of oil. And the first 2 or 3 times they tried it, it didn't work. People, the price of oil went up for a day or two, and then they went back down again because there's plenty of oil around. And actually, the U.S. is producing more and more oil, and non-OPEC countries are producing more oil now, even as OPEC and Saudi Arabia are producing less as a sort of a contrived method to try to push oil prices up. And as the world kind of shifts gradually away from fossil fuels and oil in terms of people buying electric cars and things like that, the long-term view is really moving away from, fossil fuels. And you've also got the fact that, again, China has been a big driver of commodity demand for 20 or 30 years now. So copper and, steel and concrete and, iron ore, all those things that go into making things in China and globally for manufacturing, they're just using less of them. They don't have that growth potential anymore. They've kind of run into the limits of their growth, and I don't think they'll fall apart, but I think they'll slow down, and they won't have the ability to these big kind of stimulus programs and big spending like they've done in past years. That's really driven a lot of the commodity demand. And so if you don't have the big drivers of demand there, and you don't have supply shocks, then I don't think, you really have to bet on either OPEC cutting supply or something else cutting the supplies of these things. That for the most part, there's enough, probably copper to go around for the most part. They just found a lot of new lithium here in the U.S. There's a lot of things where, price goes up some, and lo and behold, they figure out how to mine more of it or create more of it or use less of it.
Are there any? Sorry, go ahead.
Yeah.
I was going to say, are there any particular countries? Because you'd mentioned China. Are there any countries that you think have a above average or a more brighter growth potential over the next couple of years, more so than we could say the U.S.? Unless you feel the U.S. does have a lot of growth potential as well. I know you mentioned technology, but I just kind of like to get your thoughts on countries or regions of the world that you think have the most potential.
Yeah, I would say probably among the big developed markets, the major economies, I think the U.S. is still the leader and probably will be for a while. I think, Europe has done better than people expected it to over the last year or two, but that's only because they expected really bad things. And it's just been less bad than what people had thought, a year ago. But I think that, Europe and Japan face a lot of demographic headwinds, bigger ones than the U.S. does, and don't have the same, technology and kind of the real, kind of vibrant, technology and development things that we do here in the U.S. And smaller countries like Canada have a lot of exposure to commodities and don't have the same kind of growth-oriented sectors that we do here. In terms of other markets, China, I think, is slowing down. I've been underweight and kind of, less interested in China for quite a while now, and still am. I think India probably has potential. It's really kind of following a different path than China. They're kind of the two giant, emerging markets countries. I think it has a lot more potential than China does. They have some kind management and issues there, but their demographics are better, and they have if they could kind of get some of their regulatory issues and kind of make the country work a little more cohesively. I think there's a lot of potential there. Brazil should have potential. I think its leadership is not going to make that happen right now, but over the long term maybe it would. But I think the U.S. really, in terms of the place to put the majority of your money, is still the best place to be. I haven't seen any other major place that really looks better on a longer term basis.
Okay, yeah, that's an interesting perspective. I like that because it seems to be a little contrarian to the way a lot of market commentators talk. And I know you've proven to be right in your analysis to a great degree this year. So I think that's a unique perspective that people really should listen to. We actually have a couple of questions from some of our viewers. One of them is it likely that interest rates will drop after the new year with regards to home buying? I know we talked a little bit about interest rates maybe coming down and that being good for bonds, but what are your thoughts about that affecting mortgage rates?
My guess is mortgage rates will probably stay elevated, kind of near where they are for a little while longer. I'd be surprised if they were able to drop, at the beginning of the new year. I think it would probably be maybe middle or later next year before you'd really see real relief on the mortgage front. I think you would have to have the Fed talking about cutting rates or actively cutting rates to really see that come through. I think the markets will anticipate that to some degree, and maybe you see that in the second quarter if things start to slow down economically. But I think right now it's going to be tough for mortgage rates to come down until the Fed changes their sort of higher for longer messaging. That's the story they're telling, and they'll probably keep it up for a little while longer. And the bond market is still in the process of adjusting to that and getting up to the level that the Fed has kind of marked out as where they think things are going to be. So I think it'll take a little longer than just a couple more months to get relief from mortgage rates. I think it'll be probably sometime next year before we see that.
And what is it? I know I've been following how mortgage rates have been priced at a premium, kind of more so than they have in the past over, where rates are. Like I know they're based on the 10-year, but I know that they're higher. What is the reason behind that? Are you familiar with what that is?
I know you're right. Yeah, there has been a bigger premium for mortgage rates over benchmark bond rates, and to some degree, that's I think reflective of the fact that there's more they call refinancing risk essentially. If you get a mortgage at 7.5% today, and then a year from now rates are at 6%, you're going to refinance. And so what looked like a 30-year mortgage suddenly becomes a 1.5-year mortgage or something like that for the bank or whoever issued it. And that's unfavorable for them. So they're having to sort of price mortgages on the view that these rates probably won't last, for a long time. And that because whoever takes out a mortgage generally has that sort of option that, kind of like a put option to refinance your mortgage at a cost, but refinance your mortgage if rates do go down, whereas you can keep it if rates still go even higher. You don't have to, you have an optionality there. That means that people who issue mortgages and price them have to count for that. And so the fact that you can refinance your mortgage at a lower rate when rates are higher, that makes that sort of option more valuable and has to be priced into the rate that you pay.
Okay, yeah, that makes a lot
of
sense.
That makes sense, yeah.
Yeah, absolutely. That makes a lot of sense. Okay, we got another question here. This is actually a fiscal question. It says, in light of the fact that we continue to borrow money at the federal level, what do you think will be the results when the federal budget reaches a point where the entire income of the budget is required to pay interest on the debt? That's kind of an interesting question.
Right.
You have any thoughts on that?
Yeah, I don't think that that's going to happen anytime soon. I think that interest cost within the federal budget is going up, but to some degree, that means that there's more money going out into the hands of the private sector, which then lifts nominal activity and therefore taxes. So it's the deficit or interest cost as a percentage of GDP that matters more. And I think it has gone up, but it was extremely low before. And a lot of that really is just a function of interest rates, and which means that it's a function of what the Federal Reserve says. So if the Federal Reserve decides to lower interest rates, then that problem will go away or be reduced. So I don't really see it as a problem at the federal level, actually. It's more state and local governments and the private sector where people who are over leveraged can get into trouble if rates go up and stay high for longer periods of time. But at the federal level, the money that goes out as interest is money in the hands of the private sector, and therefore can be basically part of the tax base. And so if the proportionally taxes don't change or even go up a little bit, then that will balance out. And again, I don't think rates are going to stay where they are now 5 years from now, 10 years from now, over the longer term. I think rates will come back down again at some point, and that will reduce that pressure in terms of the interest cost. So I'm much less worried about it at the federal level. And certainly we've seen places like Japan have issued much more debt relative to their economy than we have, and have had no real problems with it. Because if you're the currency issuer, you can get away with it.
What is it with Japan? Is there a reason they've been able to do that we have not? Like we talk a lot about, or at least sometimes you hear in the news, either about government shutdowns or about fiscal crisis, and yet Japan has a lot more debt than we do. I know some of that is demographics, and some of it may be higher savings rates. But have you done any research on that? Like, what is it that enables them to sustain such a high debt level, compared to us, if you will?
Right. Yeah. Well, I think some of it is, certainly savings rates and things like that. And some of it is, the Bank of Japan owns almost half of the Japanese bond market, the government bond market. So wow. The amount that's outstanding in sort of notional terms is actually maybe only half the size in terms of what's in the private sector, actually held by non-governmental organizations. And even a big part of that is held by things like life insurance companies in Japan, where they're required in many cases to own government bonds as part of their capital, or just as a risk thing. That's true to some degree here by U.S. banks. They have to own treasuries and things, or at least very safe assets for their capital requirements. But it's less so than it is in Japan, where the requirements are stricter in some cases. And so I think it's, and then the fact that there's no, inflation problem in Japan, really. So people that own the bonds aren't worried too much about them from an inflation standpoint. The currency's been weak lately, but it's generally a stable currency to own for people globally. And their economy is, it doesn't grow much, but it's stable. And so all those things, I think, mean that any kind of a federal level debt crisis is much less likely and much less of a problem, so that you can get away with financing, more if you have a lot of stability built into the system, essentially. And that's what Japan has.
Well, Sam, we've really gotten a lot of value from your time. We really appreciate your time. You're sharing your knowledge with us. If anyone wants to follow your work or wants to reach out and contact you, how do they reach you? What's the best way to get in touch with you or follow you?
Sure. I would say the easiest thing certainly is anyone who's on Twitter, follow at Mill Street Research on Twitter. I post there pretty often, updating kind of my general views on the macro things and sectors and industries and all kinds of things. I'm also on LinkedIn, again, Mill Street Research on LinkedIn, where I'll post updates of my comments or representative kind of articles and things, or media appearances. And then if you can go to millstreetresearch.com, you can see kind of what my research looks like. There's example reports. So there's a blog, and there's a contact form there. So anyone who wants to reach out, who might be interested in the research or wants to touch base, can certainly do that way. And there's an email address there as well, info@millstreetresearch.com. You can email directly. But if you kind of want to see what I say and examples of the work, I would say that Twitter and LinkedIn and the website are the best place to do it.
Well, great. I will make sure to post links to those below this video.
That'd be great.
Again,
thank you.
Sam, thank you very much for your time. We'd love to have you back at some point in the future.
Oh, it'll be my pleasure. Thank you for having me on.
Yeah. And to the viewers, thanks for watching, and don't forget to subscribe.